Welcome, first of all. You have a packed house. Everybody's stayed because they would like to hear you, and you're the last speaker of the day, and there's some delicious wines, which they're going to go and taste after this. But you have been a guest here before. I think that your books have been a source of terrific inspiration to many, many people. And I'm going to start with one. You wrote The Big Secret, and then modestly, I heard you say that it stayed a big secret because no one bought it. But in fact, it was all about patience. And I think you used to give advice to your students as you taught, as you have done for so long at Columbia. What was the advice you gave them?
Well, I promised them the first day of class that if they did good valuation work, the market would agree with them. I just never told them when. Could be a few weeks, could be a few years. But that was the secret. I mean, stocks are ownership shares of businesses. The market eventually gets it right, and eventually can be a long time sometimes. And but that's really picks apart the fact that stocks are not pieces of paper that bounce around, that you put Sortino's ratios on. They're ownership shares of businesses, and eventually the facts come out and the market gets it right. So if you get it right, you'll get rewarded eventually.
Patience. Well, we haven't talked about patience. They've talked about the valuation opportunity in the UK and Japan. But let's turn to the US. Lots of portfolios around the world have more and more US equities as its percentage of the world's market cap has risen, and within it, of course, the concentration. You run the Gotham funds. You've had a terrific long-term track record. How difficult is it when you have this level of concentration?
I would say it's difficult to beat the averages when you have this level of concentration where the top stocks do the best, but it's not unique. There's been a lot of studies showing that only about 4% of the stocks account for 100% of the returns of the stock market. And so you don't know, let's say at the S&P 500, if there's going to be 20 stocks that account for 100% of the returns, which ones are they going to be? It's been very rare that the very largest stocks are in those 20, so it's not the concentration that's rare. It's that the largest stocks continue to grow at well above market rates with well above market profitability. And I think it's unique in history so far that they've been able to keep it up. Usually you've had companies that have their run and then, the law of large numbers kicks in and they just can't keep doing it. And I think because of the internet and the networking effects and all these things that, we're all familiar with now, that dynamic certainly has changed. But of course, if the market fully reflects at some point the fact that these are still great companies and there are, these Nifty 7 or whatever they might be called nowadays, how long their run might be, it makes it more difficult if you don't have those in your portfolio. But having said that, a lot of them are really good companies that, a good value investor could buy a number of them, not all of them, but some of them have great attributes. As Buffett would always say, growth and value are tied at the hip. So that, when you're valuing a business, part of that growth, part of the way they can reinvest their money at high rates and grow their earnings, that all comes into valuation. So if you're really viewing value the way I do, which is like a private equity investor, cash flow oriented, looking at cash flows going, not some statistical way of looking at low price book, low price sales that Russell or Morningstar might classify as traditional value. It's just more the same. These are great businesses that deserve good multiples, and the market's reflecting that. But what is rare is that these biggest companies continue to do quite well. If you have a market cap weighted index, of course you're going to be, even though it's funny, I used to think about it this way: market cap weighted indexes guarantee that you're going to do the wrong thing at every stage. If a stock is overvalued, you're going to own too much. If a stock is undervalued, you're going to own too little. And you're going to do it automatically. All right? If you don't believe all the stocks are efficient all the time and that some are overvalued and some are undervalued, you don't even have to know which ones are overvalued or undervalued. When you do a market cap weighted index, you just know that if it's overvalued, you own too much. And if it's undervalued, you own too little. And so what we're literally saying is that even though the largest companies have accounted for a big chunk of the returns, they were undervalued. They're still the biggest. So you can be the biggest allocation and still be undervalued. being the biggest, and that's actually what's happened, and that's sort of the rare part, that these big companies could be mispriced that way. So, it's just interesting, I would say, more than anything else. I mean, it's still a market of stocks, not a stock market, and you evaluate each company, and even if in that book that no one read, The Big Secret for the Small Investor, one of the things I talked about was that when you're a stock analyst, you don't actually know the values of all 500 companies. If you know a company well and you buy it at an attractive price, you can beat the risk-free rate, adjust for the risk that you're taking by owning that business, and beat that adjusted rate, meaning get paid more than what you're worth, but that still could underperform an index. You can make 12%. If the index does 14, you didn't do well. But, if the risk-free rate's 4%, you could do 12, and you find that company. Does it make you a bad investor? Not really. Does it make you underperform the index? Yes. And so it just really depends how you want to benchmark how you're doing. Are you getting well compensated for the risk that you're taking, and, even more than what you're entitled to? And if you're doing that, I argue that you're a successful investor. Doesn't mean you will have a successful business, because if you don't beat the index, you're not going to have a successful business.
And I noted, going back through your records, I think it was 98 and 99, you had poor down years where the S&P was strong, and then you came back with a huge plus 100% year. Are you managing money differently 24 years on?
Sure. So back then we had concentrated portfolios, and we just did what we do. And in 98, the market was up, I think, 28%. We were down 5%. And then in 99, it was up another 21%. And we started in 85, so that was our first lost year in 98. And then 99, market was up, I think, 21%. We were down another 5%. So aren't we kind of fools? Or the market's not agreeing with us, or what we were doing wasn't working anymore, or things had changed, who knows. But in 2000, the market was down about 10%. We were up about 115%. So I viewed it as just, we got paid for all the work we did in those years. They didn't want to pay us for that. And, it was the same position. So we eventually were right. And, what I had told my students actually came true. We did eventually get paid for doing good work, but it zigged and zagged quite a bit differently from the market. Now we have much more diversified strategies. We're hundreds of stocks on the long and short side. And it's not that one's better than the other, a concentrated book or diversified long-short strategies. It's just two different ways to make money. We have a big research team covering the companies, and there's different ways to risk management. It's just a different challenge. And we found it fun. My partner, Rob Goldstein, joined me in 1989, and we've been working together since then. So this was just another way to sort of make excess returns. And, we've had a long short fund that was 130 long, 30 short since 2008. And, we've managed to significantly beat the market with that since then, even though we generally are way underweighted some of the Magnificent Seven during that period. That was a period where traditional value has not done well. It's way underperformed the market, and this way outperformed the market. So I think it just bottoms up valuation and related investing. Let's not call it value investing. It's got a bad name. Let's call it valuation-based investing. Still works pretty darn well.
And, in the ubiquity or the omnipresence of passive investing, we've got lots of active investors here, how do you think that journey of passive plays out?
Well, I think it's best for most people. I think what Buffett said, most investors should just index. And I gave a speech many years ago at Google, and I opened that way. I said, even Warren Buffett says most people should just index, and I agree with him. And I said, thank you very much, and I, left the room. But I came back, and I said, but then again, Warren Buffett doesn't index, and neither do I. How come? And, the best way I can explain it is, what I used to tell my students at Columbia, years ago. At some point, I think I've told this story before, but at some point during the semester, someone would ask, hey, Professor Greenblatt, congrats on a great career, but, now there's more computers, more, investors, more ability to, more availability of data, and, it's more challenging, more competition, so you did great, but isn't the party over for us? And so at that time I said, look, why don't we go back to when you guys learned how to read, and, and I told him, from whatever it was, 97 to 2000, the market, the S&P 500, which is 500 of the most followed companies, that index doubled. And from 2000 to 2002, it halved. From 2002 to 2007, it doubled. From 2007 to 2009, it halved. And, from 2009 till today, it's done pretty well with some bouncing around. And so that is the most followed companies in the world. That's an index of 500 companies. That's an average, doubling and halving, doubling and halving, doubling and halving. If you lift up the covers and look underneath and look at the individual companies there, it's a much wilder ride. The index is smoothing that ride, and yet the index is doubling and half and doubling and half. So if you believe that, this is fair value and the market goes around fair value like this, the market, it's very emotional. You change a few numbers. You move one number up, growth rate up 1%, discount rate down 1%. You get double the price or you get half the price. And, when people are optimistic, they make optimistic assumptions. When they get a little pessimistic, they make pessimistic assumptions. And the math says it doesn't have to be that great to make a huge difference. And so we're always going to see it. We're always going to see these wide, I'm writing another book and I just called it Math Plus Human Nature. Okay? The math doesn't change and neither does human nature, and so it's going to keep going like this.
And when you think about the short side, which you practice, you talked in the past about names like Rivian, which at that point, I think their cars were costing $200,000 to make and they were selling them for $100,000. Are you finding enough available targets on the short side? And has your short approach, which we've seen other long short managers disappear and leave the pitch, has that changed?
Yeah, so shorting is very, very difficult. We view it more as if you're going to do it, I don't know if it's called a rifle shot or whatever, meaning just picking individual names. I think we all know the problem with that is that if something's twice as expensive as it should be, it could go to 4 or 8 times as expensive, and we've seen that. And so it's very hard to live through. So we view it more like being short hundreds of names at once. We're not short more than a few basis points in each name, and we're trying to be right on average. It's kind of like being an insurance company where you want to have a lot of bets that make sense over time, but nothing in particular hurts you. If you're selling term insurance, someone young unfortunately dies and they only give you $1,000 and you just paid off $1 million. Well, if you just, issued 5 policies, you could get really hurt. But if you're doing hundreds and hundreds or thousands, then you're going to hit your average pretty closely. And that's the way we view shorting. And we're not just short, we're long against our short. So in other words, there's something we like better. And then you can decide how much risk do you want to take? Do you not want to take industry risk? Do you not want to take all kinds of risks? So we're very fundamental in the way that we put together our valuations and, what we think is cheap and what we think is expensive. But we're very quantity, people would call it, in our risk management. So for instance, and I've given this example before, momentum has worked in general for 30, 40 years, not just in this country, but across the globe with a few exceptions. And I have no argument that it has worked. But we don't use momentum to pick stocks. Why? Because what if it didn't work for the next 2 years? Momentum didn't work. It could be that, it's a long-term factor and it works over the long term and 2 years is too short, so just keep doing it. Or it could be that, it's now a crowded and degraded factor and it didn't work because it doesn't work anymore, okay? 2 years from now, if it didn't work, I wouldn't know the answer to that question. Is it, just be patient, or is it crowded and it's now degraded and it doesn't work anymore? But when I'm balancing 2 portfolios, a long and short portfolio, I want to have the momentum be similar on both sides. So we use it in risk control, even though we're not using it to pick stocks. So there's a difference there, and so we're very quantity in portfolio management to manage risks, but not in valuing businesses. I guess that's the best way to put it.
And when we think about companies staying private for longer, about lots of the dynamics, Michael Burry, who was here last year, was talking about the life cycle of companies. Do you think that the pendulum swings, and broadly, as the cost of capital has risen, and it isn't as easy for so many companies to play some of the games that has been played, that there is a there is a reason for more to return to the stock market?
Well, I think when you look at it, and when I got started, and there are probably 9,000 companies public in the U.S., and now I don't know the number, but it's between 3,500 and 4,000 or something like that. So far less numbers of companies. Companies are bigger, and as a percentage of GDP, the public market is still bigger than it was when there were 9,000 companies. But one of the things I love to do, and one of the things that I think it makes the United States vibrant, is a good public market. And I think we've regulated the smaller companies out of the public market. It's become too expensive to go public when you're small and to raise money from a diffuse group of people, which is a shame because, smaller investors can't take advantage of some of these companies that are growing and probably have the most growth ahead of them. Because if you got to pay $3 million a year in expenses to be public, so even if you earn 10 million, not 10 million in sales, but you earn 10 million, you can't be public because you're giving away too much in expenses to be public. So you can't really have very many small companies that make sense with all these regulations. And so it's very disappointing to me. And they've tried to make some changes, but they haven't worked. And so I would just say we've overregulated that market. I mean, a lot of things that happened with, Enron going back and that was like outright fraud. Didn't matter what laws you had. That was outright fraud. And it was illegal then, and it's illegal now. And, I understand the good intentions of preventing investors from getting hurt, but I think the overcorrection has been wildly to the disbenefit of public markets and wildly to the disbenefit of small investors and the opportunities that they present, and wildly disincentives to businesses that get going that aren't in the favored group of venture capital firms or whatever, just more mundane businesses or just more things that aren't just happen to be popular in private funds. So, yeah, I have strong feelings about it, and I'm disappointed.
Yeah, we actually have talked a lot in the UK, which has been very self-critical about the number of delistings in the UK, but in fact, it's proportionally very similar to the US, so delistings have also been a global phenomenon. I'm going to turn to the audience so I don't dominate everything. Any questions that anybody would like to start with? Number 2.
Oh, hi, it's Steve Clapham behind Balance Sheet. Mr. Greenblatt, thank you for doing this, and thank you for your books and sharing your wisdom. I've got a question on education. I took my elder boy to the United States a few weeks ago to look at US schools. What's your view on what's happening at Columbia, and what would be your advice to him?
Oh, my expertise is in investing. Look, it's very disappointing what's going on campuses, many campuses in the United States, and I think many faculties have extreme non-mainstream views. For the most part, they represent one viewpoint that is not in the mainstream. And I think that's been a problem in the United States, the way things have been developed. I think there's plenty of great things going on at universities as well. And I think this is a problem that needs to be solved better. As far as advice to you, I think it's very important that your son finds the right spot for him. I would say that, having 5 kids of my own, I think it's a lot what you bring to the table, bringing them up and their interest in learning and being a lifetime learner, which is much more important. And so some atmosphere which is conducive to learning, how to learn, teaching courses that are of interest are probably the most important. But big picture, I'm very disappointed, and I'm hoping there's a change on campuses in the U.S.
Thank you.
Great. Question, gentleman here, white shirt, hand in the air, coming in, number 1.
Hi, Joel. Thank you for the knowledge you've imparted over the years. When you were running Gotham Capital 30 years ago, at times you were running with 4 to 6 stocks in your portfolio, quite concentrated. I'd love to hear, what drove that change to what you're doing now. I think managing a portfolio, I think you mentioned 300 to 500 names. What drove that? And is there anything structural you'd say has changed that led to, why you decided to do that?
Yeah, that's a great question, and I get it a lot. My partner and I did the same thing, and I was doing it beforehand, before we joined together. So for a long time, since the early 80s, one style, usually 6 8 names were 80% of our portfolio, and there's absolutely nothing wrong with that strategy. It is quite volatile, so it's not that conducive for other outside investors. It's unavoidable that every 2 or 3 years you'll wake up and lose 20 or 30% of your net worth in a few days. That just happens. And I did that for a long time, and it works. I got very interested in going back and doing some of the research that I had done on Ben Graham when I was in business school, researching his theories and formulas, and I got interested in adapting it to a more Warren Buffett good and cheap type research because I just love learning, and this is one of my areas of expertise. And so we came into something we thought would also work. And so there's more diversified long-short portfolios. And so they both make sense. They're both full-time jobs. We couldn't do both. We're going to try something new. I love them both. I have kids, and the ones that are interested, I've taught how to do the concentrated way of investing, and I still love that. And if I were starting again, that's what I'd do. And this has been interesting, showing that the principles that we use to run those concentrated portfolios could be applied to more diversified portfolios of hundreds of stocks on the long and short side, and then it also works. It's a different thing. It's less volatile. I don't wake up every 2-3 years and lose 30% of my portfolio. We don't make 30, 40, or 50% a year either doing that. And so there's trade-offs in both. They both work in their own ways and with their own properly, if you know ahead of time what to expect, goals. And I've enjoyed both. So I wouldn't read anything that I like one better than the other. I would say if I were starting again, I would start just how I did.
Great. I think we have a question there, number 2.
Joel, very interesting to hear your thoughts about the debate between active and passive, and whether the pendulum towards passive has gone too much in one direction to the point that markets have become much less efficient, there's less price discovery, and actually active management is quite important and it contributes to the efficiency of the markets.
That's a good question, and I think David Einhorn has said that in some of the smaller names, not the major names, they're not as closely followed or evaluated, or the active funds that used to buy these names sooner aren't there anymore. And I think to some extent that's all true, but I think what I said to my students is true. The facts usually come out. We might have to wait a little longer for them, but the market eventually gets them right. People are still people. What I said before, math plus human nature is the whole game, right? You make a few different assumptions. And so I just gave that speech about the S&P 500 that's always been carefully followed, doubling and halving, doubling and halving, doubling and halving in a very short period of time. And so I'm not worried if it doesn't make it easy to beat the market. If you're not really skilled at valuing businesses, you have no business picking stocks. You're much better off indexing. I think indexing is the right solution for most people. But if I'm talking to students or a group of professionals who are good at valuing businesses, I think it's a very worthwhile endeavor. And there are probably more opportunities in some areas than there were when there were more active funds. So all those things are true, but nevertheless, if you enjoy this, it's still, I think, there are plenty of opportunities out there.
Joel, you've written there are different ways to be a value investor, and I wonder whether you might just expand that a bit.
Well, different ways. One of the things I was thinking about is you could be long only and patient. You could be very concentrated like we were. You could be long short and very diversified. The definition, I guess we should define value investor. We could define it also as investor, right? Where you figure out what something's worth and try to pay less. That's what investing is. And, one of the things that, my students would say is, well, some companies, like if I'm trying to figure out normalized earnings in a few years and, there's a lot of competition and, the business is changing and it's hard for me to come up with that normalized earnings. what do I do? And I would say skip that one and find one you can figure out, because you have no business investing something. If you can't figure that out, you have no business investing. And for most companies, that's the answer. It's too hard. I can't figure that out. It's not too hard for somebody, but it's too hard for you. You can't be an expert in everything. So I think the best advice to investor is Warren Buffett's advice: know your circle of competence. And it doesn't have to be large. You just have to have one. And if you don't have one, go index.
Got it. Question here, number one.
Mark Rubenstein, net interest. Joel, had a lot of students pass through your classes, many of which have gone on to forge successful careers as investment managers. How early can you spot a good investment manager? And assuming that you may allocate some of your own capital to either these students or others, what skills do you look for in investment managers?
That's a good question, and I probably come from a different thing. We started something called the Value Investors Club. It's still going strong. Over 20 years ago. It's at valueinvestorsclub.com. It's still free. You have to apply to get in. It's really hard to get in, but the write-ups there are a great way to learn. There's a delay on there, even if you're not a member, so you can just read old ideas and see the investment string and everything else. And so, I would grade lots of papers every year, and so there were 2 or 3 year students out of 40 or so that really would have gotten A+ in my class when they write out an investment idea. And so it's just a logical thought process that you see them go through. They don't even have to be right. They just have to think logically and build a case that's very clear and simple. They have a tendency to be able to simplify complicated things, or find something else they can simplify. And so it's kind of clear to me when I read a great investment write-up or two, I say this person is a good thinker, and it doesn't make them a good portfolio manager, it makes them a good analyst. So I think a good investment manager has the combination of being a good portfolio manager and a good analyst, both at the same time. So that's what I would look for. It's not as easy as you would think, and most of the people, if they're there for the money, because if you're pretty good at this, you get paid well, that's not usually the person that's the most successful. It's someone who just loves figuring out things, likes the process of figuring things out, and that's really what I'm looking for. And you're not really looking at outcome. You go look at portfolio managers, and there is no correlation between last 5 years and next 5 years in general. That's just the facts for most portfolio managers. So what you really have to look at is process. Does their process make sense? Are they putting it together right? And that's really the key. And not everyone, in some ways it's as hard to find a good manager and predict a good manager it is to find stocks. But what you're looking for, individual stocks. So you can pick stocks or you can pick a manager. Most people aren't good at that. That's another reason just to index. And that would be my answer.
Great, we've got 2 questions here at the front.
Yeah, thank you very much. Just curious, with your new strategy where you have more, like 100 stocks and more, how much do you do automatically, like in terms of financial research? Do you use computers more as opposed to traditional kind of manual work where an analyst would dig into the 10K? And how much of your research is based on financial data as opposed to non-financial industry insights? Do you use any third-party more data on, parking lots, etc., as opposed to 30 years ago when you started? How much did you deviate from pure desk research? Thank you.
Yeah, so we have a research team. We don't use an outside database. We created our own data. We're looking through the financials for every company. We're looking backwards, not forwards. And on average, that works. Even though for an individual company it wouldn't, on average, it works quite well. And that's what we're doing.
Got it. We've got a gentleman here at the front. Number 2, if you can come to the front, because you've been very patient, sir.
Good afternoon. My name is Ajit Dayal from Quantum Advisors, India. Question is, when you graduated from Wharton, 1980, US economy, GDP was about $3 trillion US. Now it's about 8 times that. S&P has gone up gazillion times since then. At that point in time, I guess for the last few decades, your focus has been primarily the developed world. Now, if you look at India, GDP is $3 trillion, where we were in 1980 in the US. Have you expanded your universe to look outside of the developed world to look for value, or are you sticking pretty much to the developed world? Thank you.
If I were younger, I'd look at India. We've developed an expertise in the United States, and we still think this is a great place to invest, so we're investing here. But I think what you're suggesting makes a lot of sense for young people. I mean, there's rule of law issues there, protection of property rights, and I would be very familiar with those rules before I would feel comfortable investing there. But if you know those rules and understand them well and how that system works, I think that's a great, whether it's a suggestion or you threw it out there as a hypothetical, I think it makes sense. I really do.
Number two.
You know Berkshire Hathaway extremely well. When Warren joins Charlie in the great investor club in the sky, what are the prospects from your point of view for Berkshire Hathaway?
Look, I'm sure they'll do fine. He's put together a great group of people. You know, for the last many years, you know, their returns haven't been significantly bigger than large cap returns, but they've been able to keep up with the S&P without owning most of it. They had Apple, but not most of those other names that have, you know, been extraordinary because they have a group of really good businesses that are run well and a good stock portfolio. So they've been able to do well, and I think they'll continue to be able to do well. I will say there is no one like Warren Buffett and Charlie Munger that I've ever met. I had the privilege of taking my Columbia class to meet with Buffett years ago, and I've never met someone who was more, I mean, and it doesn't matter what their net worth was. I think he was worth $60 or $100 billion at that time. He was so gracious, you know, for just anyone that I've ever met, compared to anyone I ever met. I just want to shout that out, that I guess you can be that successful and remain that gracious. I think that's rare and unique and probably has helped him in every way possible. And it's a good lesson for all of us that no reason to be otherwise. You can be very successful. So that's the lesson I learned from him better than any other. And I learned a ton reading everything that they've written and everything that they've said over the years. But that was the best lesson I learned, just meeting him and seeing what a gracious person he could be.
Thank you. When you look back through the very best investments you've picked in your long career, there can be lots of types of it, be it a stock that's contrarian and you double down and then you make it, or a great compounder that you hold for a long time. Is there a pattern in terms of the very best stock picks that you've had in those different types?
That's a great question, and it's, you know, I opened You Can Be a Stock Market Genius, which was my first book, with a story about my in-laws who spent the weekends looking at yard sales and country auctions during the weekends, looking for paintings or antiques that they could buy that they thought they could make money from. When they saw a painting they liked, it wasn't whether this painter would be the next Picasso. Their question was a similar painting by the same artist just go up for auction for 3 times the price that I can pay for it here? You know, so it was really their sourcing of ideas, looking off the beaten path. They weren't on Madison Avenue buying paintings. They were, you know, at a yard sale or a estate sale looking for those things, and they weren't predicting the next Picasso. There's a really different skill sets. And my skill set was more like them, looking for those antiques in the yard sale and looking for something that got created in a weird way that any idiot more or less could have figured out was worth something if they looked here and, you know, were mildly capable at doing analysis. And I would say that was my skill set more than it was predicting, you know. But then again, Apple traded a number of years ago and we had in our portfolio at 7 times earnings, and, you know, wasn't much different. It's just you tilted your head this way and said, hey, you know what, maybe this isn't quite only a hardware manufacturer, and maybe there is an ecosystem that's worth something. And that was our analysis. The real analysis was, boy, what a gateway to the internet was really where the value, and this is going to be where most people come to the internet. I didn't quite get all of that, likely Buffett did, as to why they bought it. But I knew it was more than just a hardware company, and, you know, you were able to buy it, you know, well. So sometimes those worlds come together. It's very rare. And we bought some really great businesses that were produced off the beaten path in some way. And the key is to hold those. And then the ones that you're just buying cheap, you know, to trade, you know, what I said was you trade those and you hold, or, you know, for the long-term ones, if you're able to create a business at a good price and hold it because it's a good business, will continue to grow. It's almost the analysis of margin of safety, right? You know, when Graham would find a cigar butt and, you know, pay $6 for something that was clearly worth 10, but it wasn't this great business. So slowly, maybe the 10 is only worth 8 and your margin of safety would shrink. Whereas opposed to if you could pay $8 for something worth $10, but that $10 was growing at 12 or 14, your margin of safety is actually growing over time. So which one had the bigger margin of safety? It was most likely the one you paid more for, but the value was growing over time and you felt good about it. And so it's sort of the way I look at things. What am I buying? I think you want to stick in general to good businesses that invest their money well. And more and more and more, I've gravitated towards that over the last 30, 40 years. And, if you want to go away with something, that's what I'd go away with. Yes, you'd like to buy it well, but make sure you're in a good business, and that takes care of itself over time.
Okay, 3 more questions.
Hi, Joel. First of all, thank you very much for speaking to us and for your books, which have been, I'm sure, a source of inspiration for many and certainly for me. A quick question about the private markets, if I may. So we're coming off of sort of a 40-year run of interest rates progressively getting lower and lower, which has kind of fueled success in the sort of leverage buyout market, and that's fueled private equity and now private credit. Potentially that might be turning, and there's a large allocation from, particularly US institutional funds to private markets, and that has been growing in recent years. They've got a lot of dry powder. How do you kind of see that playing out in a potentially new interest rate environment, and does that provide opportunities? Does that spill over into the public markets? I'd be curious for your thoughts.
Yeah, if rates are permanently higher than they were and expectations, you still are expecting an equity risk premium when you buy a business, and that's all stocks are, right? So when you're private equity, you're just buying a business also, okay? You have more control over it, but you're buying a business. And when you buy it, you're expecting that this bouncy earnings stream that you're going to get from the asset that you're buying will beat the risk-free rate plus enough to compensate you for the risk that you're taking. And so the prices that are being paid should eventually adjust to higher rates so that there's still a spread there. Was there unusually large spread because rates were unusually, or everyone would say artificially low? Yeah, I think that was a big tailwind for a long period of time. So will the returns be quite as good? No, but it still comes down to, you're buying an asset. I got to borrow, this is my cost of capital. How much more will I get over time, and is it worth the risk that I'm taking to get that expected earnings stream, and just be that evaluation. It is like picking stocks. Some people bring a lot to the table in the private equity business in running a business better than it would be, but I think that's far overstated. And, I guess if I had a good long-term record, I'd say, yeah, I was great too, but I think everyone's fooling themselves, and most of the time it's the same management, so I don't think it's different than the stock market. I think prices will adjust to higher rates, and you need to be compensated over time, and people will want to be compensated over time for taking additional risk. And so, it was a very good environment for private equity and for the stock market during this period. And I still think prices will adjust so those two things are in line over time. And, so I don't want to make a longer term projection than that. There'll be short-term dislocations when those get out of whack.
Okay, number 1.
Joel, Cole Smead from Smead Capital Management. I was one of those people affected by your book, How to Be a Stock Market Genius, so I want to thank you for that first. You like looking back. I like looking back. Let's look back to the Nifty 50. You mentioned the Nifty 7. You got into the business when companies like Coca-Cola had just gone down over 50% over 7 years, from 72 to 79. What are the odds that these blue chip American businesses, as overexcited as they are, run into something like that? Could there be a simplicity patterns that's a high return on capital business, and 30 years later we laugh that people used to invest in companies that did knitting?
The real answer is I don't know. My intuition is that these, at least, a pile of these, 4 or 5 of these 7 businesses are some of the best businesses I've ever seen in my life. The law of large numbers usually kicks in, way earlier than here, let's say, has historically. IBM isn't what it once was, Kodak isn't what it once was. And so stuff happens, and it'll happen to some of them. But I do think the franchises and the network effects and the existence of the internet changed the dynamics for these businesses. Some of these businesses, sometimes they're mismanaged as well, right? Some of them with different managers weren't doing quite as well. So I think some of that happens. But I'm not sure that we're seeing the crazy prices for these things I mean, there is a relationship, there is an easy case to make about, the earnings yield versus the growth rate going forward that some of these businesses have and their moats or franchises that they have. So, like I said, the real answer is I don't know. Many of them strike me as higher barrier businesses, but you never know. I mean, we saw ChatGPT come out of nowhere last year and, at least scare Google, who owned search for a long time. And, I think Google has a lot of comebacks to it and, will be very strong and still tough to take. And they got a lot of different businesses. So, it's all interesting. I'm always learning. I don't think they'll all make it, but I think some of them will continue to grow at large rates for a period of time to come.
Great. So the last question is this gentleman here.
Thank you, Mr. Greenblatt, for all your insights and accumulated wisdom so far. And I was happy to hear you're working on a new book, so looking forward to that. My question, I wanted to ask you about, you have obviously vast experience. I wanted to ask you about how do you and how an investor should learn from mistakes. I was curious if you have any quantitative approach to this, given that you have one for the portfolio management and the construction. So, yeah, thank you.
Nice question, because it's really hard without losing a lot of money to learn. There are times where you make money that you don't deserve, meaning you got lucky. Usually it's like I bought it cheap and it ended up being worth a lot more than I thought. And so I got lucky and I got extra money. And there are times when you buy something where, it's kind of, you couldn't have anticipated that event. I certainly didn't anticipate COVID, even though it seemed like there were warnings out there. I was telling my kids at the time, this wasn't in the playbook. I never, wasn't expecting this horrible thing to happen ever and the world to close down. And so, sometimes it's unforeseeable, and sometimes you just make mistakes, meaning your analysis was wrong. And those are the ones I try to learn from. And those are the ones I remember that I either bought too much or my thought process was wrong here. And I think the advice I give someone to try to learn investing is you can't learn it in a vacuum. You actually have to invest real money, and it doesn't matter how much. It just has to be important to you. You have to lose enough money that it's important to you, and that's my advice. Lose some money doing something you thought was right, and then try to analyze why you got it wrong. Even if it's a few $1,000s, but that's important money to you, you'll learn just as much as if you're losing millions. And I've certainly learned a lot by making a lot of mistakes, and I'll just give you some encouragement. My partner Rob and I have laughed, and I believe in a very successful career that we both had together, and I've been doing this for 40 years, and of course the market went straight up, so that helped. I would have said, we both laughed that if we worked for someone else, we would have been fired at least 3 or 4 times. We made such egregious mistakes. So, hang in there, learn from your mistakes, and move on.
Joel, you have been very generous with your time, sharing your experience, your wisdom. It's been terrific, I think, for all of us here. Joel Greenblatt, thank you very much indeed for being with us today. All content on the Money Maze podcast is for your general information and use only, and is not intended to address your particular requirements. In particular, the content does not constitute any form of advice, recommendation, representation, endorsement, or arrangement, and is not intended to be relied upon by users in making any specific investment or other decisions. Guests and presenters may have positions in any of the investments discussed.